So the good thing about what inflation does to multifamily is that it's still putting your money into real estate. It's still a store of value, right?
Mhm.
Because if the asset is being run properly, you're still increasing your rents, you're still keeping up with inflation or beyond inflation, really. So it is a store of value, right?
Uh-huh.
That asset that you're investing in is increasing in value too, right?
Right.
And you're increasing the rents, works out great. If you're investing in some of the opportunity zone stuff that we're doing, for instance,
Mhm.
because that just happens to be the projects we're doing here in Cleveland, majority of
Mhm.
them are opportunity zone.
Yep.
In that case, you're putting your money into an asset like this Rockefeller deal, for instance, and in 10 years, when the OZ matures, you pull all your cash out and the gains all tax free.
Right.
That's huge.
Right.
You're not going to get nailed on capital gains or anything else like that. You could pull it out sooner at 7 years, but I think it's some percentage less. I think like 20 or
Right.
30% less, or at 100% tax free at 10 years, right?
Mhm.
You can't beat that deal, right? There's nothing else on the planet that you can do that with. You can't
Right.
do that with Bitcoin. I'm not knocking Bitcoin. You can't do that with crypto. You can't do that with NFTs. You can't do that with any other
Right.
asset. You
Right.
can't do that with stocks. You can't do that with bonds. You can't do that with
Right.
real
In
estate's
fact,
the
if you
only
pull
thing.
out of money from the stocks, you could have potentially put in opportunities on funds and
Yeah,
actually offset some of the capital gain there too, which is a great vehicle.
yeah,
Yeah.
yeah. But it's still a fund though. Whenever you have a gain, you're still going to
Right.
pay gains on that, right?
Right.
So that's the thing. I mean, yeah, it's there's nothing else like real estate. That's why people in Congress they leave real estate alone because the majority of their wealth is tied up in real estate,
Uh-huh.
right? If you think about it, right?
Yeah.
Just do
Yeah.
what they do, right? Right.
Yeah, exactly. And how did you guys expand it to like triple net leases or commercial? For folks who doesn't know, that is commercial spaces, commercial real estate spaces. Yeah.
Sure, sure. No, it's a great question. So like I said before, we have our stabilized asset, our development, and our net lease type of business. The net lease business is actually a fund. Okay, so what that means is we go off and raise capital, and it's a blind pool, and we do obviously what we're targeting to buy is the single tenant net lease type of assets. And what is
Mm.
that exactly? Think of Advanced Auto Parts, CVS, Walgreens, Burger King, McDonald's, Starbucks, your single tenant store that's in a great location or good location that has a corporate guarantee. These are all like usually publicly traded. They're AAA or B rated, companies that aren't going away anytime soon.
Uh-huh.
The cool thing is that what we do is that we do monthly returns, right?
Mm.
And we're targeting 7 to 10% return, something like that, maybe more, but generally that's what the range is.
Mm.
And the thing is that we did that fund because there's sometimes deal flow between multifamily and the development side. There could be gaps,
Yeah.
and we know investors still want to invest with us. So we figured, hey, you know what? You put your money into this fund. Sure, the returns are not going to be as juicy as
Uh-huh.
say a multifamily or a development deal,
Right.
but it's a risk adjusted return.
Right.
It's a
Yeah.
very low risk. I mean,
Yeah.
is Starbucks going out of business tomorrow? I would bet not.
Yeah.
I would also say that to have a monthly return, if I can tell you that you're going to get a check in the
Right.
mail, or every month on the 5th, it's going to show up. I can tell you can bet on it. It'll be there. It's kind of
Right.
like you have that versus multifamily, where the stuff that we and anybody else buys, if there's a bad month, let's say for instance a bunch of boilers fail at a property,
Right.
it's not covered by insurance. You got to fix
Right.
it. What does that mean? That means nobody gets paid that month, or
Right.
that means that it comes off the NOI because now we got to fix it. Wasn't
Right.
planned or whatever. Right? So it's kind of like that. Where with net lease, it comes down to our ability to find a great property, have a good relationship with the vendor, with the tenant that's there, and of course having that lease that's locked in, and we know that return is going to be coming every month. That's huge. That's
Right.
huge for those folks that are looking for that type of return.
Right.
So that's what we
Yeah.
did it.
It's kind of like a less return, doesn't mean it's a lower risk, low returns. That's like the rewards and the risk. And then you have to kind of choose what your risk profile is as an investor as well.
Right.
Yeah.
But still, you know what, though, you're still talking like 150%, 180% return. I mean, it isn't like it's terrible or anything else like that, you know, but it's like, because, yeah, I mean, it's syndicated in the same way we do everything else, really. It's the same sort of structure, you know, we don't take
cash flow.
So it's like we go in, we buy the asset, we buy a group of assets, not all at once, you know, we buy the asset, we hang on to them for about, let's say, you know, 5 to 8 years, maybe 10. But when we sell, we pull out the equity, give it back to the investors, and boom, there you go. You collected money all the way along, and then you get the equity back at the end. I mean, and you do it all over again. I mean, it's not a terrible deal, you know. So it's just different.